Time for Chart Attack, where we've got two charts that are going to make you smarter. We're here with our closer, and he says when it comes to investing, you got to go east. And it has to do with growth, doesn't it?
Right. I mean, right now, if you look at the forecast for the U.S. economy here and the European economy, we have a chart up for folks. They look pretty low. They look pretty low over the sort of the first half of this year. And then look at what the economists are forecasting at Morgan Stanley for the Chinese economy. I think we can get that bar up now.
And there it is. So that is growth.
Maybe we're overcomplicating it, Adam. I mean, which one of these bars do you want your portfolio to be exposed to? Now, you could say, well, hey, maybe it's in the price or, you know, but we have a whole separate chart coming up after this one, which hopefully we can get up, which shows the price to earnings ratio of the U.S. companies that have China exposure, and they trade at a discount to the U.S. companies that don't have China exposure.
So you're buying into faster growth at a cheaper price.
Right, and that's
a cheaper peg ratio.
That should be a good thing. And these are the U.S. companies, so you know what the accounting is, you know what the earnings quality is, what the management quality is. So I just think that there's so much negativity about China and the trajectory. Whether the actual economy grows 6, 7, 8, I don't really care. It's all so much. That one bar is so much higher than the U.S. and Europe bars, and I think I want to buy this basket. And that's one of the strategies we've been advocating to outperform.
So what's going on? Why are Chinese stocks trading at such a discount? And of course, as we just showed with the chart, American companies that sell into China, why are they trading at a discount to so many others?
I think there's just a lot of fear about the growth trajectory there, about the magnitude of an infrastructure build out. And there's
in other words, people don't believe that 8% growth rate.
They don't believe the 8% growth. They don't believe it's sustainable. And my point is, I can buy the U.S. companies. If you talk about Chinese equities, that's a different kettle of fish because they have different accounting standards and earnings quality. But here, there's a basket that contains many of the high-quality U.S. industrials and healthcare and other companies. And I just think it's just oversold. And so one of the things we're advocating, besides some of the stuff we alluded to earlier, higher quality companies and dividend, is to get this China exposure at a discount.
Understood.
Yeah, like that.
Morgan Stanley's Adam Parker. Great having you on the show.
As always.